In Boston, an attorney named Daniel earned $190,000 last year. He kept $300,000 in a checking account at his bank, the same bank his parents used, the same bank his grandfather used. The account paid him 0.01% interest. Last year, that $300,000 earned him $30. Not 300, 30. At the same time, his bank earned roughly $12,000 on his money by lending it out at 5.5%. $12,000 in revenue from his deposit. $30 returned to him. $11,970 in margin extracted from the gap between what he was paid and what they earned with his money. Daniel didn't know any of this. He thought a bank account was just where money lived. Here's what nobody tells you. Where you keep your cash determines how much your bank profits from your loyalty. And there are 6 accounts that almost no traditional bank will mention to you, because each one of them moves your money out of the margin they extract from your deposits. According to the Federal Deposit Insurance Corporation, the national average savings account rate as of early 2026 is 0.39%. Meanwhile, the top alternatives we're going to walk through today are paying between 4 and 5.5%. On a $100,000 balance, the difference is roughly $5,000 per year. Per year. That you keep, instead of giving to your bank. I want to walk you through 6 accounts that exist outside the relationship most Americans have with their primary bank. These aren't secrets in any conspiratorial sense. They're public, regulated, and easy to access. But your branch banker has zero incentive to tell you about them because each one represents money that walked out the door. This is a documentary about a banking gap, not financial advice. Let's start. The first account is a TreasuryDirect account where you buy debt directly from the United States government. Most Americans have never heard of TreasuryDirect.gov. It is the official website of the U.S. Department of the Treasury, and it allows you to buy Treasury bills, notes, bonds, and inflation-protected securities directly, with no broker, no fees, and no middleman. The interface looks like it was designed in 2003 because it was. But the math underneath it is the most favorable cash math available in America. A 4-week Treasury bill, as of early 2026, yields between 3.7 and 4.5% depending on the auction. A 52-week Treasury bill yields slightly higher. Both are exempt from state and local income taxes, because federal debt is constitutionally protected from state taxation. For someone in California or New York, that state tax exemption alone adds nearly a full percentage point to the effective yield. On a $100,000 balance held in T-bills versus a high-yield savings account, the after-tax difference in a high-tax state can run $500 to $1,000 per year, just from the tax structure. Banks don't tell you this. They have no business model in routing you to TreasuryDirect. The second account is a high-yield savings account at an online bank. Online banks like Marcus, Ally, Capital One 360, Discover, and SoFi pay between 4 and 4.5% annual percentage yield as of early 2026. Your traditional brick-and-mortar bank, on average, pays under 1%. The structural reason is simple. Online banks have no branches, no tellers, no real estate. Their cost structure is roughly 1/4 of a traditional bank. They pass some of that savings to you in the form of higher interest because they're competing for your deposit on yield, not on convenience. Most people keep their savings at the same bank as their checking because nobody told them they could keep their checking convenience while moving their savings to an account paying 10 times more. The 2 accounts can be linked electronically. Transfers take 1 to 2 business days. The yield difference on a $30,000 emergency fund is roughly $1,200 per year. The third account is a brokerage cash management account. This one almost nobody knows about. Most major brokerages, Fidelity, Schwab, Vanguard, offer something called a cash management account or a money market sweep. It's not technically a bank account, but it functions like one. You get a debit card, you get bill pay, you get check writing, you get FDIC or SIPC insurance. But your idle cash is automatically swept into a money market fund that, as of early 2026, yields between 4 and 5%. That's higher than most online savings accounts, and the cash is fully liquid. Fidelity's cash management account, paired with their money market fund called SPAXX, has been a quiet powerhouse for high-balance savers for years. Schwab offers something similar through their checking and money market combination. Banks don't recommend these accounts because the brokerage replaces the banking relationship entirely. Your direct deposit goes there. Your bills get paid from there. Your savings earns yield there. The bank loses every layer of margin at once. The fourth account is a health savings account, used as a long-term investment vehicle. An HSA is technically a healthcare account, but it has a feature so favorable that financial planners quietly call it the most powerful account in the U.S. tax code. It is the only account where money goes in tax-deductible, grows tax-free, and comes out tax-free, as long as it's eventually used for medical expenses. No other account does all three. Not 401k, not Roth IRA, not anything else. Most people use their HSA the way the marketing suggests. They put a few thousand in, spend it on doctor's visits, and refill it. But the optimization that financial planners use is different. They max out the HSA, $8,550 per family in 2026, invest the entire balance in low-cost index funds, pay current medical expenses out of pocket, and let the HSA compound for 30 years. At average market returns, $8,500 contributed every year for 30 years becomes roughly $1.4 million, tax-free, as long as it's eventually used for medical expenses, which in retirement you absolutely will have. No bank tells you about this strategy because there's no banking margin in it. The HSA lives at a brokerage, the contributions come from your payroll, and the bank never touches the money. The fifth account is a 529 plan, even if you don't have children. Most people think a 529 plan is only for parents saving for their kids' college. That used to be true. It is no longer. As of January 2024, under Secure Act 2.0, unused funds in a 529 plan can be rolled over into a Roth IRA for the beneficiary up to $35,000 over their lifetime, after the plan has been open for 15 years. This is a structural change in how 529 plans work, and it's one of the most under-discussed financial planning developments of the decade. What this means in practice: you open a 529 in your own name, you make yourself the beneficiary, you contribute steadily for 15 years, and at the end, you can shift the funds to your own Roth IRA, or transfer the beneficiary to a future child or grandchild. In the meantime, the contributions get state tax deductions in over 30 states, the growth is tax-free, and qualified withdrawals are tax-free. It's a flexible, long-term, tax-advantaged account that almost nobody uses unless they specifically have college-bound kids. Banks have no products to sell you here. The 529 lives at a state-sponsored plan administrator, often Vanguard or Fidelity. The sixth account is a Series 1 savings bond, also bought through TreasuryDirect. I-bonds are inflation-protected savings bonds. Their interest rate has two parts: a fixed rate set when you buy the bond, and an inflation adjustment that updates every 6 months based on the Consumer Price Index. The composite rate as of November 2025 is around 3.5%, lower than peak 2022 rates of 9%, but still meaningful as a hedge. The structural feature that makes I-bonds unique: they cannot lose nominal value. The principal is protected by the U.S. Treasury. The yield can never go below zero, even during deflation. And the interest is exempt from state and local income taxes, with deferred federal taxation until you redeem the bond. The limit is $10,000 per person per year, or $20,000 for a married couple. A 1-year minimum hold is required, and selling between 1 and 5 years incurs a 3-month interest penalty. For someone building a long-term inflation hedge inside their cash allocation, I-bonds are the most efficient instrument available to retail investors. Almost no bank will route you toward them because the bank earns nothing on a TreasuryDirect purchase. So those are the 6 accounts: TreasuryDirect for direct government debt, online high-yield savings, brokerage cash management, the HSA used as a stealth retirement account, the 529 used as a flexible long-term vehicle, 529 used as a flexible long-term vehicle, and Series 1 bonds for inflation-protected savings. Now, the part that matters. Let's add up what these accounts could mean for someone with $100,000 in cash and a moderate annual contribution capacity. Imagine someone who moves $25,000 of their cash into Treasury bills, $50,000 into a high-yield online savings, $20,000 into a brokerage money market, $10,000 annually into an I-bond ladder, $8,500 into an HSA invested in index funds, and $10,000 into a 529 with themselves as the beneficiary. Compare that to leaving everything in a traditional checking account at 0.01%. Over 5 years, the structured allocation produces roughly $26,000 in additional after-tax yield. Over 20 years with the HSA and 529, compounding inside their tax-advantaged shells, the difference becomes hundreds of thousands of dollars. Same money, different containers. This is the core of the banking gap. The bank you grew up with is structurally not designed to optimize your cash. It's designed to extract margin from the cash you leave there. The accounts I just walked you through are designed differently. They route the yield to you instead of to the institution. The work to set them up is real but bounded. A weekend of paperwork establishes TreasuryDirect, a brokerage cash management account, an HSA, a 529, and an online savings account. Once they're open, the money management is largely automatic. The yield difference compounds for the rest of your life. Now the nuance. Not everyone benefits equally from every account in this list. The HSA only works if you have a high-deductible health insurance plan, which not everyone does. The 529 makes the most sense if you can hold the funds for 15-plus years and live in one of the 30-plus states that offer state tax deductions for contributions. The I-bonds make less sense if you need full liquidity within a year. The Treasury bills make less sense if you live in a state with no income tax, because the state tax exemption advantage disappears. Each account has a profile of who benefits most and who can skip it. The point of this video isn't that you should rush to open all 6. It's that the choice of where to keep cash is not neutral. It's a transfer of yield, and the default option, your traditional bank, transfers it away from you. This is a documentary about a banking gap, not financial advice. For your specific situation, talk to a fee-only fiduciary advisor who can map these accounts to your tax bracket and goals. I'll see you at the next one.